Welcome to our e-signal Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we're going to take a look at will be the Australian US dollar. Aussie US dollar, we pretty much foretold that story in last week's report. You were up against long-term resistance, primary pattern resistance. In fact, the resistance held. You couldn't get back to it, and the fundamental backdrop to that, essentially the picture, the pattern on the chart is a reflection of the underlying fundamentals. That fundamental story pretty clear cut. Indecision, weakness in China, the same in commodities. So weakness in commodities, weakness in China. The world views the Aussie as a commodity currency. There you go. Long-term resistance held. It shifted all these short-term patterns down, and that spelled the end of any budding rally there. Aussie will be interesting to watch. We'll watch that level, very significant level there, by the way. You know, you get a couple closes below that on a daily chart, maybe even a weekly close below there, and by all means that'll open the door to back to selling rallies in that market. And we haven't said that in a while, right? We've been kind of friendly on that market since it held that level, but if it closes below there, we're back to selling rallies in the Aussie. Next market, dollar Swiss. A big turnaround of the dollar Swiss. You know, it's fascinating how these patterns work against the backdrop of the global economy. For sure, we pointed out that resistance level there. Sure enough, that resistance level held. That was the 25-day pattern resistance held. Resistance holds, and it shifts those short-term patterns back down. So looking at dollar chief here, as much as we like it long-term, from a day trader's perspective, we're selling rallies in this guy. Back to short side, back to selling rallies. I think you got a shot at testing 98 even. It's one of those things, if I like it at 98 even, I love it below 97 even. So really, the cheaper that guy gets, the more I like it. So hopefully we do get an opportunity to buy a big dip here, and rather than just getting cash positions, I think you get a dip here, and that's the time to use leverage stepping out. So hopefully we get one more shot at buying a big dip here in the Swiss. If you love it long term, short term, however, as day traders, we're working the short side. Intermediate term, we're definitely looking at these significant levels right below that you see I have marked in that market. Dollar index, similar story. Interestingly enough, here you actually did shift that 25-day pattern higher last week before you got the short-term shift here. So, you know, dollar index, I'm a broken record on that. I love it. I think any dip you get in here, be it short-term or intermediate term, is going to be an opportunity to buy. Any dip into that level, and that's going to be an opportunity to add to current positions, be it just cash positions, or I would even recommend leverage down there. You see support hold, you get a momentum shift on a lower time frame chart, and I think that may be the time to go after this guy, go long the dollar with leverage. Euro US dollar, you know, the euro chart, similar to the couple of charts we just looked at, really the significance of intermediate term support and resistance of intermediate term levels, it's so important to us. Look at that level. It held like a champ, and it actually gave us a buy signal in our new swing trading method. Here's the performance of that new swing trading method. I love it. It gives us the opportunity to go counter trend too, and that's what we saw here. You see there's a 25-day pattern held, so we went long on 1.6 earlier in the week, and it wasn't a whole lot of risk. I think the risk on that trade was 52 ticks. Initially, we came out of the first half with a 74 tick profit, and we're still letting that run. We're up 130 ticks, 130 pips as of right now. So playing that short-term hop worked out well for us, and it really highlights an advantage you have as a trader as opposed to longer-term traders such as the hedge funds. Hedge funds had a terrible year in 2015, by the way, because they're not able to take advantage of short-term patterns, intermediate-term patterns. Their main focus would be on the big picture, long-term. That's a tough way to make money, too, in a market where if there's one thing that has changed in the last 5-6 years is that you're seeing counter trend moves are longer. You're seeing corrections, they take much longer, both time-wise and price-wise. And as a trader, just managing your own money, you need to be able to be adept to take advantage of that. And you can see that, you know, I'm always talking about long-term bear in the euro, but when you look at our swing trading, which is for us a longer-term performance, look at that, we're making money on the buy side in the euro. So you need to be able to obviously swing both ways there. However, from a long-term standpoint, you got resistance piled up in that euro up above 110 the figure. So I'd be licking my chops at the potential for setting up a long-term leveraged position somewhere just below 112 in the euro. So we'll keep an eye on that. Gold taking advantage of weakness in the U.S. stock market. You're getting a bit of a counter trend move, a little bit of a short squeeze there. You gotta like selling gold in that resistance between 1120 and 1140. Personally, I will probably, when you get gold up there, and that'll probably coincide with stocks being a little bit lower, I would take, rather than sell gold in the zone, when you get the signal in gold, I'd probably use that as a signal to take a hard look at going long the U.S. stock market too. I'm not going to cover the stocks today. I think they got a little bit more downside to them, but when that time comes, I will definitely cover them. I like buying a dip in the S&Ps here, but it may be quite a bit lower than where it's at now. But from my perspective, from a historic perspective, it wouldn't be all that much lower. Well, heck, as long as I'm on it, I'll pull it up. Here's what I'm looking at. Here's the S&P 500. You get closer to 1800, ideally, 17 and a half, that'd be even better. Not sure if it'll get down there, but if it does, I would definitely take a good hard look at the stock market as far as taking a nice position in there. Back to the gold market, it's just a dead cat bounce. Really, again, taking advantage of temporary weakness in the U.S. stock market. U.S. interest rates, last guy we'll cover. Not a whole lot going on in interest rates. Really no change. But really, you're just seeing these shorter term patterns get jerked back and forth. We were together last time, and all the short term patterns, along with the long term patterns, were up. Guess what? They rip them all down. But in the big scheme of things, you're still within that trading range that you've been in. You're just at the bottom of the range. So maybe an opportunity for a counter trend buy signal in line with those higher time frame patterns that were up, or just be patient and use this as an indicator market, which is what I do. So U.S. interest rates, really no change there. Long-term patterns are still bullish for Treasury yields, i.e. bearish for the Treasury market overall. And that spells higher rates in the United States in line with current Fed policy. My name is Jay Norris. I teach at Trading University. Thank you so much, and we'll see you back here next week.